Okay, so when doing an acquisition, remember there's there's three major transactions here, right? It's the raising of the equity, the raising of the debt, and then actually purchasing the PP&E. So when beginning with purchasing the PP&E, what do we do? What's the first step? Kind of conceptually. Where do we begin? Yeah, cash flow. What do we do in the cash flow statement? Right. 10 million. Right. We run the investment of the PP&E, the money that went out for purchasing the PP&E. 10 million. Which would lower our cash, and that flows to the balance sheet. Right? Cash goes down, and our PP&E asset goes up. We purchased an asset. Okay. But then on top of that, we have depreciation expense. Right? New depreciation for a new PP&E. We made the assumption that this asset's going to depreciate over 10 years, just to make the math easy. So if we make that assumption, then the depreciation is 1,000. How does that run through the model? Or through the income statement, cash flow statement, and balance sheet? Where do we begin with the expense?
First, the PP&E.
Sorry?
You said the PP&E expense?
The depreciation.
Oh, sorry.
expense. Yeah.
Starts from the income statement.
Income statement.
Cash
Increase
flow.
expense 1 million. Taxes on that, let's say it's 40%. It's 400,000. So our net income decreases by 600,000 because of that interest expense. I'm sorry, because of that depreciation expense. Then where does that go?
It goes to the cash flow.
Yeah, goes to the cash flow. Net income at the top goes down by 600. Add back T&A. That's the next line of the cash flow statement, by 1 million. There's also deferred taxes, additional deferred taxes created. We'll get to that in a second. Okay. So that is a net 400K increase of cash because of depreciation. Right, the income goes down, depreciation goes up. So we have 400K. So the question is, how does that depreciation flow into the balance sheet?
Wasn't in the cash. The 400 wasn't on cash.
Yeah, cash goes up by 400K. Here. Depreciation expense reduces our asset by 1 million. That's a net negative 600K. And how does it balance?
With retained.
Retained earnings, because our net income is negative 600K. Then there's deferred taxes. Right, we're going to assume that on this new asset that's depreciating for GAAP purposes, we will also accelerate the depreciation on that asset for tax purposes, creating a deferred tax liability. So we assumed 50%, I think. Makers 50%, just to make the math simple, just to, and that was 50% on the property of 10 million is 5 million, and to convert accelerated depreciation into deferred taxes, we take the accelerated depreciation, we subtract the straight line depreciation, multiplied by the tax rate. So the accelerated depreciation was 5 million, straight line was 1 million, that gives us 4 million, times 40%, that gave us 1.6 million. So 1.6 million deferred taxes. So how does that flow through? Goes in our cash flow, right under the D&A. Deferred taxes 1.6 million. Flows right to cash, 1.6 million. Bless you. How does that?
It's a liability.
It's a liability. So we have cash up by 1.6 million because of that. Liability deferred taxes 1.6 million. So we have our property in there. Cash went down by 10, PP&E went up by 10. Next question is, where are we getting that cash from? How are we sourcing that cash? And we're assuming we're going to source it by $5 million in equity and $5 million in debt. So let's start with the equity. Let's let's assume we're raising 5 million in common stock. Where do we do that? Where do we begin? Cash flow. Financing activities, stock goes up by 5 million. That gives us cash, total cash of 5 million. And how does that go into our balance sheet? Cash goes up by 5 million in our balance sheet. And how does that balance? Where does stock go in our balance sheet? Shareholders' equity at the bottom. So it balances. Then we have additional shares and dividends, which affects our EPS. And you gotta plug that in. Then we raise debt. 5 million in debt. Where do we begin doing that?
On the cash flow.
Debt schedule, which flows into the cash flow. Here we'll start with the cash flow. Long-term debt, let's assume, 5 million. How does that flow into the balance sheet?
Liabilities.
Long-term debt and liabilities goes up by 5 million. Cash goes up by 5 million. That's it. Then we have interest on that. Right? We're assuming 5% on that 5 million is 250 in interest expense. Let's say 40% taxes, 100 in taxes, so our net income, because of the interest, has reduced an additional 150K. How does that flow? Almost like the depreciation. Well, not quite, but net income goes down by 150. Our cash goes down by 150. That goes to the balance sheet, cash down by 150, and our retained earnings goes down by 150 because of our net income.